Welcome to Talk Tickers, the briefing designed to get you inside the numbers and, ahead of the narrative. Today, we're doing a really critical deep dive into the Q3 2025 earnings for UWM Holdings Corporation. That's ticker UWMC, a huge player in the U.S. wholesale mortgage space.
And our mission today is to really move past that immediate stock drop. We need to understand the tension here. You've got this incredible, powerful operating machine on one side, and on the other, you have this just unrelenting volatility from the financial accounting side of things. We're going to get into their tech bets, their debt structure, and what management is really signaling for Q4 and beyond.
And volatility is absolutely the right word. I mean, we saw this great disconnect in the Q3 results. If you just glance at the top line, the operational story as well, it's undeniable. Revenue hit $843.3 million. And that wasn't just a beat. It crushed consensus by a stunning 20%.
It was a monster quarter for them, production-wise. Loan origination volume got to $41.7 billion. And just to give you some context on that, that is the largest quarterly number they've posted since, the peak refi days of 2021. And their preferred metric, adjusted EBITDA, was very strong at $211.1 million.
Okay, so record volume post-2021, massive revenue, yet the market acted like it was a total disaster. Why? Because all the disappointment was coming from the bottom line, specifically the GAAP figures.
That's it. That's exactly right. When you look at the standard accounting metrics, the whole picture just flips. Adjusted diluted EPS came in at only a penny. That missed estimates by about 6 cents. And if you look at the actual GAAP net income, the company only cleared $12.1 million. That is way down from the last quarter and basically flatlining compared to the operational results.
And the market's reaction was just decisive. Despite that huge revenue beat and the record volume, the stock got hammered. It traded down, 9 to 10% on heavy volume right after the release. It's a crystal clear signal that investors look right past the operational strength and focus squarely on those accounting figures.
And this just forces us right into the core issue for any of these non-bank mortgage originators.
Yeah.
It's this constant battle, operational strength versus accounting volatility. Management was so clear on the call, they kept framing Q3 as their best quarter since 2021. And, they did it by just dominating the loan flow.
Right. They navigated a really tough rate environment. The gain on sale margin, which is basically the profit they make on a new loan, that improved to 130 basis points.
And getting that margin expansion is pretty remarkable given how competitive it is out there. The key driver was really anticipation. Management said they were basically prepared for that short-term rate rally that happened in Q3. And that let them just open the floodgates on refinance volume. We're talking $16.5 billion in refis. They just flipped a switch.
And that gets to their execution story. It's really impressive. They handled an all-time record lock day of $4.8 billion in September. To take in that much volume without your systems melting down is a huge technical win.
Yeah, it is.
And on top of that, they got more efficient, cutting in close times from 12 days down to just 11.
Right. And that combination, massive capacity plus speed, that's the whole argument management is making. They're saying, we've built the fastest, biggest machine in the business, and it's incredibly efficient when that volume finally comes back online.
But then you hit the wall. The MSR conundrum. MSRs, or mortgage servicing rights, for anyone who needs a refresher, are these non-cash assets. They represent the future income from collecting payments on the loans they service.
Exactly. And the big drag on that tiny $12.1 million net income figure, it was a massive negative fair value adjustment of around $300.8 million on those MSRs. And why did that happen? Because when rates dipped in Q3, the market assumes more people will refinance. So that future income stream from the MSR gets shorter and it becomes less valuable. That non-cash markdown is what just crushed their GAAP net income.
And we know management's pushback on this. They've been saying it for years. They reiterated their stance. They do not hedge MSRs, period. They're adamant that investors should just ignore this and focus on the cash economics of the business, like that adjusted EBITDA number.
Yeah, they see that $300 million swing as just irrelevant noise. It doesn't affect their day-to-day operation. Their argument is basically, look, we don't take credit when MSR values go up, so don't punish us when they go down. But here's the analytical problem, and it's where the market clearly disagrees. If it's just accounting noise, why does the stock get punished every single time this happens?
That is the key question, isn't it? It signals a fundamental distrust, maybe, or concern that these non-cash swings are masking a deeper risk, like the massive prepayment risk they have if rates really do fall.
Right. And then you have the balance sheet compounding that anxiety. Liquidity still strong, about $3.0 billion, which is good. But They priced $1 billion in new senior notes due in 2031.
And that new long-term debt pushed their non-funding debt leverage up quite a bit. It went from 1.90x equity in Q2 up to 2.45x in Q3. And for you listening, that's basically their long-term debt relative to their equity, not counting the short-term lines they used to fund loans.
Yeah, that jump from 1.9 to 2.45, that's a big move. It tells you they're prioritizing long-term capital for things like tech and insourcing over, say, paying down debt. So this higher leverage, combined with total equity actually declining, that's a cautionary note for investors, especially anyone who relies on that big dividend. It's a classic trade-off. Growth versus stability.
Okay, let's shift to the strategic playbook, because this is where management feels they're really winning. Their focus is, it's undeniably on technology and just controlling the entire client lifecycle.
And the star of the show this quarter was Mia. It's their proprietary generative AI loan officer assistant. And this is not just buzzwords. This is AI actually driving massive volume.
Let's unpack what Mia does, because this is where the deep dive really pays off. She doesn't replace the human broker, she just makes them way more efficient. She crunches all this data on past clients, finds the ones who are most likely to refi at current rates, and then she starts the conversation.
And the results were, frankly, phenomenal. Management said Mia made over 400,000 calls in Q3. But the crazy part is the effectiveness. She got an answer rate over 20%. They were only forecasting like 10 or 15%.
Wow.
And this directly led to over 14,000 closed loans, and 95% of those were refis. Their tech is finding business that would have just, walked out the door otherwise.
And that focus on control extends right to what happens after the loan closes. They announced they're investing $40 to $100 million to bring all of their servicing in-house by the end of 2026.
This is a huge structural shift for them. By getting rid of outside vendors, they're aiming for two things. First, lower long-term costs. And second, and maybe more importantly, is tighter customer engagement that's centered on the broker. They want every client interaction to reinforce loyalty back to that original broker.
And they paired this with that innovative Built partnership. Can you explain that? It feels like a real differentiator.
Yeah, the Built deal lets borrowers earn rewards like travel points just for making their mortgage payments on time. But the real strategic value for UWM isn't the rewards, it's the lead generation.
How so?
Built gives UWM brokers exclusive access to between 400,000 and 500,000 renter leads every single year. These are people in the Built ecosystem who are probably thinking about buying their first home. It's a pre-qualified sales funnel, and management made it very clear that UWM doesn't pay for the rewards. It's all upside.
All right, so let's look forward and put all this in the broader investor context. The Q4 guidance was very bullish. They're expecting volume between $43 billion and $50 billion.
Yeah, that guidance signals just extreme confidence in where they stand. They see the gain margin landing somewhere between 105 and 130 basis points. It's a wide range, but it tells you they're willing to take a bit of a margin hit to keep that volume and market share up. They really believe their machine can hit the top end of that guidance or even beat it if rates give them another window.
But despite all that confidence, the stock has performed really poorly. UWMC is down about 17% over the past year. Meanwhile, the overall financial sector, the XLF, is actually up about 7%.
That's a huge gap. And it tells you the market is focused on company-specific problems, not just the macro picture. And look, we have to talk about the insider overhang. The CEO and SFS Corp sold almost 20 million shares last quarter.
Yeah.
And that just continues to be this major psychological weight on the stock.
Right. That much insider selling just creates a ceiling on the stock price, no matter how good the operational news is.
Precisely. And the analysts, they reflect this tension perfectly. The consensus is still a cautious hold with a price target in the mid-$6 range.
Yeah.
So they see the great execution, they see the tech, but they're worried about the MSRs, the leverage, and that insider selling.
Okay. We've hit the numbers, the strategy, the tension. Now for our segment where we throw out an outrageous but plausible trade idea. And as always, this is not financial advice. It's a thought experiment based on our deep dive.
Right. The setup here is high volatility, high dividend. But what's really interesting is the options market. Even with the stock selling off, open interest is super call heavy. It's a low 0.27 put to call ratio. The speculative bets are still all on the upside.
So the pitch really revolves around management's most audacious claim. They said very clearly that if the 10-year Treasury yield drops to 3.75%, UWM is ready to double its business. They mean literally doubling quarterly volume from 40 billion up to 60 or even 80 billion.
So the trade is a long-dated, deep-in-the-money call option, targeting late 2026. You are basically making a very specific bet on the timing of a big rate decline that sparks a huge refi wave. And you're banking on management's thesis being 100% correct, that their AI and their operational capacity lets them grab volume that their competitors just can't touch.
And if they pull that off, 60 billion plus in volume with expanded margins, the operating leverage would be immense because their fixed costs wouldn't rise nearly as much. The earnings explosion would probably trigger a massive short squeeze and just force a total re-rating of the stock. It would finally overcome all that noise from the MSRs and the leverage.
It's a pure high-risk bet on operational power, overwhelming financial complexity.
So to wrap it all up, the Q3 story for UWMEC is really one of these dual realities. On one hand, you have operational records driven by tech like Mia and smart moves like servicing insourcing. On the other, it's all completely overshadowed by investor anxiety about MSRs, rising debt, and that insider selling.
Which brings us to our final provocative thought for you to consider. Management believes their massive capacity, paired with their AI, makes them uniquely positioned for the next refi wave. So the question is, if that volume does double, like they claim it can, without big fixed cost increases, can that operating leverage finally and permanently overcome the balance sheet concerns and all the accounting noise? Can it change the company's valuation narrative for good?
That is the ultimate tension we'll be watching. Thanks for joining us for this deep dive.
We'll catch you on the next Talk Checkers briefing.